Over 120 countries have already adopted IFRS. India will do so starting April 1st next year. But when India does so, it will be amongst the first few major jurisdictions to adopt the IFRS standard on revenue recognition. It's new, it's complex, and it will change how we view top line forever. Hello and welcome to Mind the GAAP. Today we focus on revenue recognition, and to do that I have with me Tata Power's CFO Ramesh Subramanyam, PR Ramesh, the chairman of Deloitte, and Vishesh, the CEO of Grant Thornton. Gentlemen, to all three of you, a warm welcome. I'm going to start first by talking about why India has chosen to be amongst the first few countries, if not the first country, to adopt this particular standard. And from what I understand, Ramesh, it is that the international standard in itself has been deferred. It was supposed to apply 2017 onwards, and I think now it's been pushed back by about a year or so. Why are we the first ones to adopt this, and what are the accompanying complexities of that?
Okay, let me tell you why we are the first ones to adopt it. The international standard was to be effective from 2017, as you rightly put it, January 2017. India decided to roll out Ind-AS effective 1st of April 2016, and therefore it meant 16-17. And if India were to choose to follow the international roadmap, it would have meant applying the standard effective 1st April 17 and therefore 17-18. The impact would have been that companies would have migrated to Ind-AS effective 1st April 2016 on the basis of the old IAS equivalent, which is IAS 18, and then immediately 1 year later have to change. Now, as you know, any change involves changes to IT systems and also has its impact on top line in this case, because this is a revenue standard, investor perception of performance, compensation mechanisms, whole host of impacts will change. So it was then decided that it's more appropriate, when there was an early adoption option, to be able to align it with 1st April 2016 when you're changing the whole set of standards. So you don't need to provide a separate transition mechanism for this, and therefore do it along with the rest of it.
Is it really most appropriate? I know you disagree with what we are attempting to do.
Yes, I completely disagree with what we're trying to. I think first of all, I agree that India should align its standards overall with global standards. I think first of all, I disagree that we need to do it in this mandatory fashion. India is going through a tectonic shift. We've adopted Indian SOX. Right now, GST will hopefully come in.
Are you saying this is too complex for India to manage?
But you don't need, again, if our objective is ease of doing business.
Vishesh, that's not even up for debate anymore.
Give me an example.
Revenue.
Are
you saying India should defer its revenue recognition standard under Ind-AS?
Now let me address whether India should defer. US has deferred 606, which is FASB has deferred by a year. IASB has not deferred it, but has put out for comments, which is going to expire, which has actually dates passed, and they will consider the comments received, and most likely they will defer it by a year, because they say the reasons for deference. I'll tell you why.
So you're saying we should defer?
No, let me give you quickly the reasons. The reasons why they want to defer is the IT systems. Many companies have said that they haven't yet been able to correct the IT systems to deal with this large volume change. They need time. Second is they're coming up with additional guidance, and companies don't want to be in a situation where in the absence of guidance they take some interpretation now and produce certain results, and when the guidance comes in they may again have to change. So IASB seems to tilt on with deferring it by year. So if that is the reason, then maybe those are sound reasons for India, and 2 years is good enough.
Menaka, just if I can add to that, the question you asked, we're not talking about should India defer. I think the question we're asking is, should India not early adopt?
Let's ask the CFO on the table who's going to have to go through the pain.
If it is a good standard to have, there's no problem about the timing. I have two issues with it. One is that it's not about the systems and all. We always work backwards. Once we get a deadline, normally industry tends to somehow manage it if it is made mandatory. The issue is there are lots of related issues which need to be sorted out. At one time we are making so many big ticket changes in the legal front. There is income tax disclosure standards, then there is GST. There are implications which have across the board implications. If they are sorted out, timing is not a big deal. Even on the revenue standard, we need certain issues to be sorted
Okay,
out.
let's get into that.
Exactly.
That is really the meat of the conversation I wanted to have today. Very briefly and very simply, what is the conceptual difference between the way Indian GAAP looks at revenue recognition and Ind-AS? We'll look at it from here on.
From a big picture point of view, I would say there are no big conceptual differences. However, IFRS Ind-AS 115 or IFRS 15 provides detailed guidance in many situations, A, and B, addresses numerous transactions and explains the principle which should be applied in dealing with those transactions, which is currently absent in AS 9. The third issue is a large part relates to where there are bundled transactions, and that is where there is detailed guidance around how you unbundle an account and how you allocate considerations, which was not the practice commonly in Indian GAAP.
The unbundling of revenue is best described in a 5-step model in which a company identifies the contract, identifies performance obligations, determines the transaction price, allocates the transaction price to specific performance obligations, and recognizes revenue when that performance obligation is satisfied. Vishesh, you wanted to come in there on what the impact or implications of unbundling will mean for different consumer interaction situations or different industries.
Yeah, I think the first question you asked was on what's the big difference between this IFRS 15 and where we are currently. So where we are currently, as Ramesh also said, we are in pretty much the same place, other than for real estate, as IS 18, the global standard. In the future, what changes is, like with IFRS, a lot more judgment. And this is not 5% more judgment. This is multiples, probably 5x more judgment.
Give me an illustration if you can.
For example, if you look at variable contracts, right? So I'm an IT. So I'm an IT company.
Okay.
I go to customer promises me 1,000 seats. I promise him that I will charge you $20 an hour if it's 1,000 seats. I'll charge you $25 an hour if it's 900 seats. I'll charge you $30 an hour if it's 800 seats. Right? So he's promised me 1,000. Generally speaking, what companies would do, they would recognize revenue as to, on the basis of 1,000, but sometime through that process, when they believe on an estimate basis that the customer is not going to be able to give them 1,000, they'll start recognizing revenue at the higher value. And therefore, generally speaking, under the standard, you will have quicker and more revenue recognition than before, generally speaking. So there's that judgment that is the customer going to be able to deliver his commitment of the 1,000 seats or not. Right? And in the Indian environment, with that not 5% more judgment, but potentially 5x more judgment, you will see a lot more conversations between auditors and accounting departments, between auditors, accounting departments and external advisors, and potentially opinion shopping.
Okay.
Right?
How do you interpret what this 5-step model means for industry?
I think certain industries would have more basically work to do on splitting the activities and actually putting a number to it by methods which they will have to put in place. For example, EPC players and contracts like IT, where the longer duration would be involved. There are several elements which come into play because of the standard. So time value of money comes into play. Splitting of certain commitments and guarantees comes into play. Warranties comes into play. So there are various things which today, because of practice and the existing standard not really being comprehensively defining how revenue would be recognized, there are practices which have been developed over the years. So I see that some of these companies have to redraw their revenue breakdown, and that means presentations will be different and their top line could be redefined.
Let me give you just two simple examples of two different industries. One IT and the other is perhaps media in a way. In the IT industry today, significantly in most contracts which companies get is a bundled transaction. Now let's say I were to give you an IT contract, and typically, let me take an example of what Government of India may now put up, let's say goods and services tax. So it will involve hardware, it will involve software, could be software by the IT company itself or could be third-party software.
Got it.
and they would need to customize that software, provide a customized solution around it, and then thereafter maintenance for a single price. Maybe paid in installments in some way.
Now you have to break it down for each of them.
Now what happens in real life, what happens? When you start, and government doesn't like to deal, or for that matter any party, won't like to deal with multiple providers, vendors. So you are the front end vendor. So if you are supplying computers, equipment made by company X, in which you would reach the sites at a point in time, you would have invoiced. You also would have a back-to-back vendor invoice. Is that revenue for you? The answer is no, because I'm not selling goods. I'm selling a comprehensive IT solution.
So the top line figure will become smaller, let's say for an IT company?
The timing of the top line figure could change, could become smaller, yes.
And it could
so I'm just putting the complexities there in the unbundling.
Yeah.
The fact is, in today's scenario, it could have been relatively easy to say, I've sold equipment, I've transferred licenses, I've again procured and transferred to you. Often the license is given directly, but the payment mechanism in a way goes through me. Third is, I spend time on customization, which is over a period of time, maybe 2 years. I have computer professionals working. So revenue recognition moves away from a point in time to over a period of time. Let me give you the second example.
So one second, I think Mr. Subramanyam wanted to add to that.
Just a good example would be, you sell, let's say, a comprehensive EPC contract. And let's say we sell, for example, I'll give you a live example. We sell solar EPC. So we have a full-fledged service where we will say, I will give you 5 years of O&M free. Today what's happening is, price is bundled. There's no identification of that piece separately. And we book the whole revenue in year one when the work is done. In a new standard, you'll have to identify what's that O&M component. Put it over the number of years we use service, and you'll recognize only then. Now, the related issues of taxation and other issues by splitting this and putting it to the next years, logically it's correct, but we don't know the implications on some other areas. But that's a live example of how you will significantly affect, or let's say change the way.
So you are going to earn that revenue, except that you're not going to show it or financially report it in that particular year. You might spread it out over a period of 5 years, 10 years.
Time value of money also. So 5 years hence, if you're going to get the money, you will recognize actually for this year a different value than just dividing it by 5.
So it's basically
revenue. Not as simple as simple proportionate allocation.
There's a lot of mathematics that's going to be done for.
So it's really, earlier revenue recognized on the transfer of risk and reward. That's the basic principle under AS 9, IAS 18. Now there's also the control thing which comes back into the standard, which basically means the legal risk actually passing and the need to demonstrate that also. The only place within GAAP where control was defined or used earlier was on securitization. Securitizing debtors, securitizing receivables or debts or other things like that. Where basically you also need to now demonstrate, for example, on real estate. If someone's bought an apartment from you under guidance note on real estate, you were recognizing revenue on percentage of completeness method, right? So as the building was coming up, provided you had collected money from whoever's bought that apartment, you were recognizing revenue.
The norm was 25% post, right?
Yeah, that was the guidance. But, you could choose what you wanted, and there was a few complexities there. But that's what companies are doing.
And what would change now?
I think now what would change is you also need to demonstrate that actually the title has passed to the
so you're saying could you start booking the revenue from the day that you've signed the contract with the customer?
No, so the way the contracts are currently structured in most real estate companies, and we look at most of them, today they would not be able to. They would not be able to recognize revenue over the period of the construction. They would have to wait until conveyancing, until the
So it's the actual completion of, let's say, the apartment and handing over control of the apartment.
The way the current contracts are structured, I think that's an opportunity. I think the companies need to start looking at the contracts now and start seeing what is, the way their customer contracts are structured.
I'll give a typical example. So you have a defense contract, for example. So you have a contract which you delivered over a period of time. Today, the POCM method you could use and you could recognize revenue based on work completion and even certification. But now you have to additionally demonstrate that the customer is in a position to use it and control it. So control is becoming another element apart from just the legal title, which was the only criteria today. So that will change some of the accounting of some of these contracts.
I think it comes back to that judgment point, what I said earlier, right? Basically, you can step back and relook at your business if there is something you can sell to your customer, right? If you can sell to your customer that you can redo the contract, then literally you can get the accounting treatment you want. You can increase revenues, you can reduce revenues, it totally depends on the underlying contract, and that's the judgment that's involved. And therefore, we will have a period of 2 or 3 years where you will have, until practice emerges, particularly in this standard, where there's no global guidance also because no one's applied it.
Let me give another retail example, for instance, direct-to-home television. What happens? They bring in a set-top box, they bring in a dish, they put the connection, activate it, and maybe for a period of time it's free in terms of services. From a customer's point of view, can the customer use that asset, whichever is that asset, for any other service? No. Does it independently, does that asset give any value to the customer? No. It can only be used for that service provider and only for that. Now, what happens is these service providers, they invoice the transaction. You pay a lump sum price, but they invoice saying this much is for the set-top box, this is for installation, this is for activation fee, here is for a bouquet of packages. Now, what the standard requires is what is the transaction price? The transaction price, are those separate obligations? The answer is no, because you haven't received any, you're not receiving any value when I put the box in your house, if I haven't activated. If I put a dish for you, you want to view the programs.
But anyways, you are aggregating all of that. You may line
you
account for it separately, but you were aggregating it under the prevailing standard.
Correct.
You will aggregate it
under the prevailing standard, you are more likely going by the invoice to say, if 5,000 rupees is for the connection, 1,000 is for installation, 1,000 is for activation, and the rest free, we were accounting 5,000, 1,000 more likely. Now what it says is, you take all of it, add up the 5 plus 1 plus 1, the 7, look at what you have handed over, and allocate the transaction price to the various elements depending on the fair value of the various obligations, if the obligations are distinct. If they are not distinct, then you account for it only when you completed all of it.
I see that this standard is going to require a lot of calculations when you close the accounts. It's going to be a bit of a pain. Now, worldwide it is being done.
He's laughing.
Accountants
are delighted. Yeah.
Delightful, and I'm happy with the employment situation. So, but I'm just saying that I don't know whether the investor would be more aware or become wiser by implication of this, but I think it will bring some solidity in a uniform way of looking at things. But definitely it is going to complicate our lives.
Complicate and cause huge disparities in the way similar transactions are treated because
within
of
the same industry.
within the same
one company may do it X
and same transaction. And same transaction.
So you could have different outcomes in the real estate industry depending on how builders
which is against the entire reason why we are moving to converged accounting standards.
A builder may say, I will transfer to you undivided share, maybe 1/400 in a piece of land to you, and you pay 1 crore upfront.
Yes.
Right? Is that revenue to me? Can I even identify which is that piece of land in that undivided share of 1/400 when I put up the structure? Should I recognize revenue? So the question I have in a way for you is, do you think revenue should be recognized based on how invoicing is done and collection is done? Or do you think revenue should be recognized depending on what obligation I have discharged to you and the value you have received?
Coming up, will this new standard lead to revenue deferrals?
I'm trying to understand for my viewers the variety of industries that will get impacted. And it seems to me no one is going to be spared. I think Mr. Subramanyam brought up power, brought up defense.
People who have a longer time horizon and services element are likely to do much more work.
But is anybody spared? Because then we've discussed
real
estate,
pure
media,
goods
DTA.
may not be pure goods.
Consumer goods. No, so maybe the sale of RIN, VIM, Ariel may not. But the sale of a TV with a service contract may.
If it is any transaction which is bundled and for a lump sum price, and when you unbundle, you will find that one part of it is the obligation is discharged much later. will naturally impact the manner in which revenue is recognized in this standard.
Okay. Are there any types of transactions that we've not already looked at?
Oh yes, I'll give you many.
Very quickly, very quickly, I'll ask each one of you for an
instance, the other issue is on returns, right? I am selling today. Let's say I'm a pesticide company, I'm selling pesticides, and I know 40% of the pesticides will come back because of poor rainfall or unusage. Now, when I do that, I cannot recognize revenue today for the entire sale, even though I've invoiced and sold and collected. So, the right of return, the probability of that return is another. Third is the issue of loyalty programs. I give you gift vouchers, and you may not even encash those gift vouchers. I need to factor in the probability of your encashing the gift voucher, postpone that much revenue to a later date.
Okay.
Airlines.
I mean, modification of contracts. Supposing we do a 5-year contract to outsource the Tata Power internal audit, right? That,
Great.
So Grant Thornton is doing the internal audit Tata Power for I think maybe even two, but I'm not sure.
I'm not sure what undercurrent is going on in this discussion here. But the illustration.
Yes.
The illustration.
I think the illustration.
Yeah.
So there is a 5-year contract at a particular rate,
right,
and that contract rate changes in year 4. That we discuss, okay, we'll extend this for 3 more years, and here's the rate. Do you need to go to step 1,
which is go back to year 1 of the contract and change,
and
or
catch up, adjustment on the accounting, or is it a new contract for the future? So the modifications, midterm towards the end of the contract, modification, how are they accounted for?
I'll give you one on the power side, because that I understand a little better. What is going to happen is the impact of the other accounting standards, namely on lease, where long-term power contracts. Now, the basic issue of whether the revenue will be recognized in the developer's books or the asset owner's books itself is a big question mark.
Why is that?
Because it says that if substantial part of the life of the asset is dedicated to one customer, or a very clear control of the other customer on your asset.
So it's not your asset then?
It's not only your asset. So then the whole changes the whole revenue recognition in that sense. Let's say that is not in this standard. What's going to happen is, where we have cases where we are selling power on merchant basis, for example, or power where it's not fixed on one customer, then it's going to be a challenge if the plant is the same and some part of the power is going out. We don't even know how to solve that problem in terms of, because the sale of power, the rest of the portion will come under the standard, and there we'll have to see how the apportionment of costs, etc. will happen. So it is not a very difficult thing, but we see that those complications, I don't know how the reader of the financial statement is going to really see that, and how comfortably you will understand the real state.
Investors and journalists to understand all of this?
Not really. It's the complexity in understanding is not the issue. The issue is of complexity in understanding so far as application of the standard by the preparer is the challenge. There's judgments involved, and that's why the guidance is coming out. From an investor point of view, I think it's more appropriate, because the investor will see the economic effect of the transaction and the accounting effect more closer in a way.
Okay.
That is more important, as opposed to all the upfronting or rear-ending which can happen in the manner of collection.
Ramesh, I beg to differ on the point on economic activity and accounting activity. If there are fundamental changes in the way you recognize revenue, your commercial revenue streams and the flow of transactions and money and documentation is going to be one track. And accounting is going to be on a different principle, albeit it's a very good principle, evolved principle established elsewhere, that's fine. But what's going to happen definitely is, if there is an established model of the commercial activity which is slightly shifted from the the accounting piece, I'm not sure that whether the investor will find it easier than today.
So can the tail wag the dog? Can the accounting treatment therefore renegotiate the commercial aspects of something?
You'll find there are a number of transactions where you are paid per unit or per transaction, right? You have a cost of putting up an infrastructure, which you may construct an asset which becomes the property finally of that person. And in fact, what does that person do? What do you do when you bid? You say, I expect to do 1 million transactions. Let's say it could be a toll bridge, it could be anything.
Okay.
You multiply that million by, let's say, 10 rupees and say, I expect to earn 10 million. And that 10 million will cover your cost of the equipment, cost of constructing whatever it is.
Sure, of putting up the bridge.
And the service and carrying out the service.
Right.
Now, haven't you constructed the bridge up front? If you were only constructing and he were the one running the operations, you would have paid me a larger amount up front and paid him only for the maintenance of it.
Toll, yeah.
So essentially what I'm saying, even though I'm going to be paid per use, a large part of that per use I have already earned by putting up the bridge and construct.
Okay.
So I must recognize that revenue
So let me put the question to you this way. As we come to the closing, let me put the question to you this way. Are we going to see, in most cases, 8 out of 10, an increase in the top line figure because you are now able to book revenue earlier or recognize revenue earlier, or is that too difficult to generalize?
Definitely too difficult to generalize, but the probability is you will see a lower revenue up.
You suggested that we might in fact be seeing
that is the only place I agree with Ramesh.
We'll see lower revenue.
Yes, no, absolutely. No, I think I do completely agree with that. Generally speaking, you should see lower revenue, but in the initial few years, you will have an opportunity to show the revenue you want if you are able to restructure your contracts.
Mr. Subramanyam, in the power sector, are we going to see big changes because the tail is wagging the dog in some sense?
So for power sector, this standard is not so important as the other standard which we talked about, the lease, how the PPAs will be treated. Okay, that's one. The second question which you asked is, over a period of time, there may be lower, over a period of time it will all get streamlined because the previous year's revenue, once the contract system changes, automatically then it will be streamlined. First few years, I think most likely cases of deferment of income recognition is likely than preponing of income.
Yeah. Now, particularly for companies who pay tax on book profits, MAT, that will also drive.
Okay, fair enough.
There are disclosures.
We're going to leave it there. Thank you very much for joining us on this episode where we discussed revenue recognition. Next week, we'll come back with financial instruments.